6 Eastern.
A very rapid final trades. Tim Seymour.
Chevron, we talked about Exxon. Chevron fundamentals as good.
Final one.
Microsoft, concerns about being able to monetize AI. I think they've tackled those.
Exxon. Carter actually laid this out nicely, but I do think it's a good buy here.
Wow, two oils. You're going to make it a third, Carter?
We'll do
Your
that.
chart.
Sure. Exxon and Oracle poised to bounce.
We have Microsoft, Oracle, Chevron. It's like connections on New York Times, which is really, really hard today. Folks, thank you for watching Fast Money. I've enjoyed being with you. I'll see you at some point next week, I think. A CNBC special, Taking Stock, begins right now.
Welcome to a CNBC special, Taking Stock. I'm Mike Santoli, and I can't believe they're letting us do this again.
I can't believe it either, but yet, here we are. I'm Josh Brown. Thank you so much for joining us tonight. We're very excited to talk to you.
Every August, we come back,
That's
whether
right.
you want it or not, like the jellyfish to Jones Beach.
That's right.
That's the way I'm thinking about it.
That's right.
All right, let's get right to it. It was a wild week for the market, down 3% in the S&P Monday, kind of made it all back by the end of the week. The VIX went over 50. It was wild. We're looking at the most blamed and named for the volatile action that we saw. And Josh, in celebration of the Olympics, only on NBC, of course, will award each topic a score between 1 and 10 based on how important we think the news was to the rest of the market and on an ongoing basis. 10 meaning critical, 1 meaning that it might as well not have even happened. So, Josh, put on your judging hat. We're going to get to work. First story is the yen carry trade. Lots of talk at the beginning of the week after the Bank of Japan hiked rates in a surprise move, causing that 1,000-point drop in the Dow we saw on Monday. But the markets, of course, have rebounded. So how important, Josh, do we think this will be for the markets going forward? We have our scorecards here.
Okay.
And we're going to.
Are we saying for the market going forward or for what we saw
both.
this week?
I think in general. Let's just say for this week.
Okay. I think I'm going to surprise you right out of the gates with mine. Here, we're going horizontal.
Okay.
Where are you?
I'm with you on that.
Well, maybe I shouldn't have shown mine until. All right. I was not told decimals would be part of this.
It was 5/8 important.
Okay.
Look, I think I'm with you in the sense that I think both of our scores imply it was somewhat overblown as a causal factor, maybe.
Yes.
Now, absolutely an exacerbating factor.
Yes.
There was some kind of massive unwind. There was some kind of intense liquidation at the market, and the yen moved and the Nikkei crashed. So,
yes.
So why would you say it wasn't that important?
So if we were taping the show from Tokyo, we probably would not have a 6 or a 3. We would probably have a 9 or a 10. But the simple fact is there were huge ripple effects from what took place with the Bank of Japan. By Wednesday, they had already reversed themselves. They had a deputy minister come out and say, okay, maybe we're not going to do that again. It was the third highest VIX spike ever. That's undeniable. But here's the thing. That's if you're just looking at the VIX index. If you actually looked at VIX futures, which are the tradable products.
There's a lot of VIX truthers out there. Yes,
well, we were only in the 30s on the VIX. So big story, but as far as critical impact going forward, I don't think it will have one.
To me, it falls into that category of, when you have like a quant blow up or you have something that seems like the mechanics of the market have misfired.
That's right.
And it sort of gets all the intense attention. Even, by the way, when SVB failed, when the Silicon Valley Bank went down, and everyone's like, well, we got to know everything about who has uninsured deposits and where the next shoe is going to drop. And really, it was more just a fundamental repricing probably of the Fed and the U.S. economy that rippled into some triggers.
We also didn't hear about any high-profile blowups, and that might still be to come.
That's true.
Or we might forget all about this in 2 weeks.
That's right.
So,
all right. Some say it's not all the way done. We'll talk more about that. Do want to move on to another topic that's been plaguing the markets, not just this week, but all year. And that is fears around a hard economic landing for the U.S. How important is this one? Let's have a rating.
Okay. So on this one, I'm willing to say not only was this a very big factor on the week.
I got 9.
I like that we're neck and neck here. Not only was this a big factor this week, but I think it will continue to be a big factor. We're going to this period of time now where there's not a lot of news. Economic data will be highly scrutinized, and most, not all, of the economic data is now surprising to the downside, which is a very different dynamic than what we've experienced through most of the summer.
I agree with all that. And again, I'm saying how important the fears of a hard landing are. In other words, you're not saying it's a done deal, of course, but more that this is going to be a nagging thing. And by the way, a soft landing is not everything's wonderful. It's everything's fine right now, but it could break either direction. And that's an ongoing state of affairs, I would argue. So I think we're there. That's kind of the whole ballgame.
Let's put a pin in that because we have a guest coming on who's going to, I think, really have something important to say on that topic for sure.
All right, another topic, a different sort of rate story, mortgage rates, 30-year benchmark dropping to its lowest level since April of 2023. That was just a week ago, and that move having its own impact on Treasury yields, driving that lower. So how important is this as a restart to the housing story?
So I'm here. I think it was one of the few bright spots this week that kept us on an even keel from a sentiment perspective. Okay?
Yeah.
I love it. I don't think it moved markets per se. I don't think it had that much of an impact on what traders were doing away from the home builder stocks. But the home builder stocks are, I think, an important sentiment gauge. If you think we're heading into something much worse economically, you're probably not taking D.R. Horton back to new highs.
Right.
So from that perspective, I think it had enough of a positive impact. I don't think it's a huge story yet.
I think it's an offset. I mean, rate-sensitive sectors have done better. Obviously, you had this big safety bid in treasuries. And that's something to say, if you think that the consumer's weakening, it should act as a little bit of an offset. Also, a big uptick in mortgage refinancing applications off a low level this week.
That's right.
That's another thing that can refresh spending. All right. Another topic we've, of course, been watching pretty closely this week, and this is kind of how the week started. The news that Warren Buffett has sold half of his Apple stake over the course of the first half of this year. So we can actually see the path of his stake. How important is this market-wide?
It's a big story to me. Berkshire sold $75 billion worth of stock, not just Apple, boosting their cash and cash equivalents to $276 billion. It's a large number. I've pointed out during the course of this week that's about 25% of Berkshire overall is the typical. Right now, the cash is about 31%. So it is elevated relative to normal. Also sold a big chunk of Bank of America. My opinion, Mike, is that this was the story that broke the Nasdaq's back over the weekend. The news came out, and it was just too much. And on Monday, I think it had an outsized impact. So I'm going to give this one an 8.
Right.
And I think it got a lot of people thinking, what does Buffett see that the rest of us don't see?
Finally, we have an argument here because I'm going to say 2 only because only because of what you said, which is he's on a cash raising spree at this point. He seems to want to leave this company with an absolutely massive cushion and maximum flexibility for his successor, Greg Abel. Also, Apple, he sold it down over the course of the first half of the year, and the stock went from 185 to like 210 over the course. So in other words, the market absorbed it. It was a massive position. It was half of his portfolio at the beginning of the year. He definitely is saying Apple's not a bargain at these prices. It got to 30-plus times earnings. So I agree it's not a positive for Apple. I just feel as if it can be set aside as an ongoing driver of the market.
So my reason for ranking it as highly as I did in terms of its impact is it was mentioned on top of every other story. So as a camel backbreaker, it did the trick. And
no doubt about it.
And certainly anything Warren Buffett does.
NVIDIA's new product cycle is going to be delayed. All that stuff seemed to be like one thing after another, and the market could not quite digest it quickly. One more topic we should talk about. That's the fear of an AI spending slowdown. So is it overblown, or is it just getting started? Is it not getting enough attention? Where do you place that one?
So basically, the CEOs spent their earnings calls telling us that there was a bigger risk if they were to underspend than overspend at this stage in the game. And that sounds really bullish on the surface. The problem is the cloud numbers that they're reporting represent a very obvious downshift in growth relative to where they were a year ago, 2 years ago, over the last 5 years. And it is not clear that we're going to see any kind of substantial ROI selling OpenAI, ChatGPT Pro subscriptions. I don't know how you recoup $120 billion worth of CapEx doing that. So that's, for me, this is a relatively decent-sized story. I don't know that I have it taking us over the top. But
Yeah,
I'm here.
I have it as a 7 as a kind of ongoing either nagging factor or we're going to get relief on that front at some point, maybe when NVIDIA reports earnings. But I agree with you. I understand why the market seized on this so readily, because you're having billions, hundreds of billions of dollars come out of the richest companies in the world,
Yes.
the big cloud platform providers and Meta and such, and it's getting funneled into NVIDIA, and 50% of it goes to the bottom line of NVIDIA.
Yeah.
And then the market puts a 40 multiple on that. So it's like a good way for the market in general to get itself juiced. The problem is if it starts to feel like it's malinvestment and it's not really headed for a payoff, or if it's being front loaded, then we have an issue.
Well, so look, you have CEOs telling you basically one or two companies is going to get to generative AI first.
Right.
What's the point of having a monopoly?
You mean
and $50 billion sitting in cash or $100 billion in cash? What is the point of that if you're not going to be one of those companies? It could be the type of thing where if one of these companies blinks, whether it's Meta or it's Tesla or it's Amazon, 5 years from now it could look unforgivable that you were invested in the one tech giant that slowed down spending when they needed to speed up. So that's key. The other thing, the Mag 7 comeback this week was pretty substantial.
Yeah.
We lost $1 trillion in those 7 stocks on Monday. They have since gained back $525 billion in market cap over the ensuing 4 days. That's not gaining it all back, but it's gaining a lot of it back. That's why I'm at a 6, not an 8.
Yeah. NVIDIA, was actually still down for the week and 25% off its high. So, we've had these periods before. We're going to actually talk a bit more about how that stock is set up in a bit. We are just getting started on the CNBC special, Taking Stock. On the other side of the break, focusing on the Fed. But first, here's a look at today's S&P top performers. Stay with us.
Coming up, 2 economic heavyweights clash. They said it. Plus, Monday came in like a lion. Anyone up for lamb? The week that was. And go between the lines to a new bull market when Taking Stock returns.
bring our dreams to life.
Don't think that the Fed knows something like, well, we're afraid the Fed knows something. Since when has the Fed known anything about the economy? The market knows so much better than the Fed.
I've known Jeremy for some time. I'm a great admirer of his work. He does have a kind of a market-centric view that the Fed should react to that. And spiritually, something inside, I'm totally the opposite. My thing is the law doesn't say anything about the stock market. It's about the employment and it's about price stability. And let's maintain financial stability as that's going.
I don't think the Fed needs to make the cut, but I do think the Fed should, in their playbook, be willing to be forward-looking to respond to financial instability. And I think that that's not language that's been evident in the FOMC meetings or the press conferences and in the minutes. And so I think it's kind of in the right direction, that I'd like to see the Fed less data dependent.
That was just a taste of some of the Fed-related chatter that's been going on this week on our air. The Fed's next move front and center as investors brace for a week of pivotal economic data. Joining us on set for his take is Neil Dutta, partner and head of economic research at Renaissance Macro Research. So, Neil, they said it. Tom Lee saying the Fed needs to be less data dependent. Jeremy Siegel thinks the market knows better and should be listened to. But he did backtrack on those comments slightly later. But, I mean, where do you stand on where the economy is? What is demanding of the Fed right now?
I think the Fed needs to get on with cutting interest rates. I think they should do a large upfront move. If you look at their economic projections for 2025, Mike, they have the unemployment rate at 4.2%, and they have core inflation at 2.3%, and then they have the Fed funds rate at 4.1%. We're at 4.3% unemployment. Core inflation's been doing that at 2.3 for the last 3 months, and the Fed funds rate's at 5.5%. So I think it's sort of like which of these is not like the other.
And you were saying this in advance of some of the July data. I wanted to also make clear, so you're not saying because of what happened in markets over a few days?
No, I think the markets are a sideshow. I mean, why did the market sell off in the first place? I know people want to talk about the yen carry trade, but the big sell-off in the markets happened in the 2 days after the Fed met because the data was really weak. And we have a lot of data coming out next week. And if that's weak, I would anticipate, some pressure.
Do you agree with what Professor Siegel is saying conceptually? The Fed needs to start making forecasts? Because there's a long line of people who would say, okay, maybe forecasts might be superior to data dependent, but how good are the Fed's forecasts? Not a great track record.
No, I agree with that. I mean, I think this isn't about forecasting. This is about just adjusting the policy rate to what we've already seen happen. The unemployment rate is up. It's been rising for 5 of the last 6 months, and core inflation's been coming in below expected for the last 2 months. And what's the Fed doing? Oh, we have time. We can wait. We just need a little bit more data. I mean, to me, it's a little bit ridiculous. So I do think they're kind of like holding on to this higher for longer a bit past the expiration date.
The counter to that, as you know, is, well, the unemployment rate is up because labor supply is up. The layoffs are not that worrisome. And so there's sort of a cushion, maybe structurally, tightness in the labor market. You know what I'm getting at. Yeah, even people say, hey, construction employment is actually up, and that's always been a better recession.
Immigration has resumed is another thing that you're hearing.
I think it's sort of like a little bit too much like PhD think. I mean, I look at the unemployment rate historically. It's a line that's either going up or down. It doesn't move sideways. If it's moving sideways for an extended period of time, it's because usually the Fed does something. Right. So, and then if you think about the outlook, like what about the outlook gives anybody confidence that the unemployment rate will just stabilize here on its own? I mean, housing is slowing. If you look at new home sales that haven't been started, that's down over 35% against last year. That's going to weigh on construction. You're not going to get the kind of inventory investment boom that you saw in Q2. And incomes are slowing, which is going to weigh on consumer spending. So, yeah, I don't have any confidence that the unemployment rate will just stay where it is. Looking at layoffs, I mean, you're going to be waiting too long because that's usually the last thing to happen.
What do you think they're going to do at Jackson Hole in terms of rhetoric and messaging? Where are you placing your bets?
I think that they're going to basically do a little bit of a victory lap and say that the inflation issue has been resolved. And I think that, that the balance of risks have changed, and that'll set them up to cut and sit.
That's code for, we're going to try to to get moving. Part of the big bullish case for risk assets, if you go back to the highs in July, I was saying this too, was the certainty that we were on a path for a soft landing and that the Fed was going to ease, but it was going to be able to do it deliberately for the right reasons because inflation was coming down, and slower easing cycles historically are more bullish for stocks than rapid ones when the Fed is kind of rushing to rescue the economy. Do you think they have room to sort of take it slow if they start in September?
I don't think that they should take it slow.
No.
It's not about what, I mean, like I get the signaling. Like I've seen people say, well, if they go only 25, that's bullish, and if they go 50, it's bearish. But it's really about the economic data. I mean, they're very, very restrictive. In my mind, by their own admission. So in my mind, that actually lowers the threshold for them to do a big upfront move. Because even after 50 basis points, you'd still be actually quite tight.
There's a political consideration. Donald Trump gave a press conference yesterday, and one of the things that we've been hearing from the Republicans is any kind of cutting activity between now and the election is basically a political gift to the Democrats. We know that Powell doesn't want to play that game, of course. But do you think that that might temper the possibility of larger cuts or quicker cuts? Or do you think they can look through it and just survive whatever the criticism is in the wake of their move?
It's a great question.
I'm very good at this.
To borrow from Austin Goolsbee, I hope not. I think not. But, I don't think it's going to matter one way or the other. I mean, you're sort of damned if you do, damned if you don't. So if they don't go and they do what they should do up front, then they'll have to do even more after the election, and that could look even worse.
Yeah, I mean, if it happens in September, they will have been on hold for 14 months, which is really long. It's not as if it would come out of the blue.
If they wanted to bail out the incumbent, they would have already eased.
Yeah, I mean, the idea that this election's going to hinge on 50 basis points is kind of wild anyway. I mean, the market didn't seem to focus much or react much to Trump's comments, which is kind of a reiteration of his stance that the president should have some kind of a say in Fed policy, monetary policy. Is there a genuine Fed independence question in play?
If Trump
were elected?
We'll let you know in November.
I don't think so. I mean, I think that, this is him being him. I think that, the president does have a say in monetary policy. I mean, the Fed currently is Lisa Cook, Philip Jefferson, Kugler. I mean, these are all Biden appointees, right? So the president does have a say. It's based on the personnel that you put in there.
Yeah, fair enough. Neil, great to see you. Thanks for coming by.
Thanks for having me.
All right. What a week that was, from big losses to big gains. Markets saw a big spike in volatility in recent days, but with even more big reads on the economy coming next week, where do we go from here? We're going to debate that when Taking Stock continues.
Good evening, Mr. Kramer. Thank you. Thank you for everything you do. You've been such a wonderful source of information with your teachings. I have to say thanks.
Thank you for all your advice and saving us from ourselves.
Your advice let me quit a job that I hated. I love you to death.
Thank you for everything you do. Thanks for making us money. And more importantly, thanks for keeping us from losing money.
innovation.
Global sell-off continuing.
Begin what is going to be a significantly down day. Weakness overseas. Japan's Nikkei suffered its worst day since 1987.
The benchmark Nikkei 225 dropping by, you can see they're over 12%. There's a fear in the market that the labor market is going to crater.
What we like to do is sell losers to fund winners. Because the jokers sell winners to fund losers.
The market could be a buy again, potentially, if we just settle this recession fear. And I don't think we're going to be able to do that anytime soon.
Whenever you have one of these market accidents, it's murder on the Orient Express. Everybody on the train did it. All right, welcome back to the CNBC special Taking Stock. Taking a look at the week that was, the S&P notching both its best and worst days in 2 years this week as investors grapple with the likelihood of a recession. The NASDAQ 100 remarkably finishing in the green since Monday's gap down open. But with volatility still high, is the worst behind us or is there more downside ahead? Let's bring in Adam Parker, founder and CEO of Trivariate Research and a CNBC contributor, and Rebecca Patterson, former chief investment strategist at Bridgewater Associates. Great to see you both. Adam, so we have a growth scare of some sort going on, a hedge fund panic of some description alongside of it, and, you know, some rethink about the Fed and maybe AI-driven earnings. In your view, what's the market struggling with, and how much have we repriced appropriately?
I mean, thanks for having me. It's great to be with you guys.
Yeah.
And, you know, the tee-up was right. I mean, it's a very volatile week. I think people were confused. I think a lot of the bottom-up stock pickers, I know hedge fund guys, covered some shorts, just thinking, all right, I got an opportunity to get some stuff down. And I don't want to say they're, you know, 2 feet in on the long ideas, but they're trying to kind of look at you know, some of the long ideas to add. I really think it matters if it's a growth stock or a value stock. If it's a growth stock, I don't think the major themes have changed. I think you still believe in AI semiconductors. Now you get them 35% cheaper. So there's really quality names you can look at that maybe you were worried about, whether it's NVIDIA or Cadence or whatever your favorite chip maker. I think people are trying to figure out, is this the point that I get a bottom below 100 on NVIDIA and now I have a little bit of good risk reward into the earnings print at the end of the month? I think that makes sense. So the growth themes that are in place, I think people are looking to. I think the main learning lesson on the negative side is that there is no such thing as a value stock if the momentum's bad. If the stocks have behaved bad, on average, the market's telling you they're not going to be good when the economy slows. So, like, is Intel, you know, do I want to buy the stuff that's really lagged? I don't think so, you know. And so I think that's really the decision I'm making. And the other thing I'd just say lastly is there's no question the consumer's slowing. You can't take a step back from the July earnings and say, hey, that was a head fake. That was a Japanese carry trade, or that was disparate. Like, that was not. That was whether it was Visa, restaurants, travel, auto, housing.
McDonald's had its first same-store sale drop in 4 years. It's not an anomaly.
Right. Hershey couldn't get the price. There's just enough data points across the consumer spectrum to say, yeah, it's not imploding, but it's eroding. I got an okay Uber print. I got, you know, MasterCard was better than Visa, but there's enough in that data pool to say the consumer slowed. Yeah.
Rebecca, I'd love for you to put the yen carry trade and the sort of macro frictions that we were feeling this week into some kind of perspective. Is this an ongoing issue we're going to be contending with?
Well, I think this week was a good reminder that all investors need to care about currencies. You know, year to date, if you bought the Nikkei, if you hedged out the yen, you're up about 4.6% as a dollar-based investor. If you didn't, you're up about 0.5%. So it matters in that sense. But then, of course, it matters when you have things like the yen. We had extreme positioning. The short positions in the yen were the biggest we'd seen in years, and extreme valuations. And so one slightly more hawkish than expected BOJ announcement, plus some of the worries about the U.S., because Japan is still very dependent on U.S. demand, that was enough to get that ball rolling. And we see that the global contagion was pretty severe. So I think it was a good reminder that, you know, for all of us, whether we're bottom-up stock pickers or macro investors, currency has to be part of what you're keeping an eye on, especially when things get extreme. I think at this point, you know, you look at the big banks' FX desks to get an idea where we are, and I'll just go to my alma mater, JP Morgan. They're saying maybe 65, 75% of the short positions have been unwound at this point. So there's room we could still see some more. So I don't know if we're out of the woods on this, but we probably are pretty far down the track in terms of getting to a cleaner market position.
Adam, you mentioned that you think the worst case outcome for over the coming weeks is data that continues to show sticky inflation, and we'll get some more data on that next week, but slowing growth.
Yeah.
That combination has been really negative on sentiment in the past.
Right.
You still feel that's the thing that we need to be most concerned about in the coming week?
You know, I think there was a minute last week where I thought bad news was bad and good news was good, you know, that we got into that sort of normal scenario again. You described stagflation, right? And in that scenario, I can't find any historical example where the stock market acts well.
Yeah.
So I think you're right that would kind of tilt people to the negative. I'm not really sure that's the base case and that I position for it. You know, look, it's funny, I did this risk dinner with 10 folks on the buy side in the middle of this week, and 0 people said that they you know, had anything about the Japanese carry trade as a risk until they heard about it ex post, right? So I think the challenge on Rebecca's comment on currency is like we sort of know we're supposed to pay attention, but we just don't know when. I search every earnings call transcript for every mention of the yen, and there really weren't many. In the last quarter, there was one. It was Aflac, because they have a big Japanese business.
Yeah, sure.
There's like 12 this quarter, and the currency was massively moving all year, right? So it's just hard for the bottom-up stock picker guys to have a clue about when it matters, even though I listen to her and think, yeah, she's right, it's obvious. I feel like a moron that I wasn't, you know, thinking about it.
Well, and Rebecca, I mean, you know, more broadly, what we need to always pay attention to is where the crowded trades might be in various asset classes, and also what the assumptions fundamentally are that are underpinning those. So, I mean, we talk about the currency movements, yen, dollar, but what about the idea that the Bank of Japan, you know, has been trying to tighten, going the other direction from every other central bank? Does that have real-world economic consequences that we're going to have to deal with, or is that just, you know, Japan's been kind of going its own way for a while?
Well, I do think it matters for when we talk about carry trades. Remember, it's not just about the yen. People were borrowing in yen to buy higher yielding assets around the world. And so to the degree that we're seeing Japan slowly raise rates, we're seeing other central banks, developed and emerging market, easing, that carry potential, that interest rate difference is not getting more attractive, it's getting less attractive. The other two things that tend to support carry trades are low volatility environments. Well, we can say goodbye to that, I think, for now, at least relatively. And carry trades tend to do best in stable or improving growth environments. So the carry trade has been a big factor in markets for the last year and a half, 2 years. I think it's on pause now for the next couple of months at least. And that has implications because you're going to be seeing less strength going into higher yielding markets, again, whether it's emerging or developed markets. And you have to think, if I don't have those currency gains, how does that affect my view on holding the stock, for example, right? If I'm a dollar-based investor, I want a country overseas that has a stronger equity market and a stronger currency, ideally. If the currency is going the other way, I need to hedge it out, or I'm giving back some of those gains. So these are things people are going to have to be thinking about more in the months ahead. And just really quickly on the consumer, the lower income consumer has been weak for some time now. I think the big question we all need to be asking is, what about the higher end consumer? They've been the ones who've been continuing to spend. And if they start getting more cautious and pulling back, that'll be one step too far, I think. And then we do see the economy really crack because the consumer, as we all know, is about 70% of GDP. The earnings so far on the high end are mixed, but I am a little nervous. Some of the luxury goods companies and airlines, hotels, et cetera, we're starting to see more caution there. So I am a little nervous that the bigger picture consumer story, not just the lower income consumer, is getting weaker. And the Fed's going to be watching this, and this will be as part of their thinking at Jackson Hole and then the September FOMC.
Adam, this summer, the dominant theme was the broadening. Some people looked at it in terms of the Russell rip and small caps finally participating. Some people pointed to value or cyclical areas. We went into the middle of July with a record for the present bull market of advancers versus decliners in the New York Stock Exchange. That kind of is hanging in there, but I feel like that's going to be important in the second half. I don't know how important it will be, but how do you think about whether or not we've seen the best that we're going to see in participation, or if the best is still yet to come?
Yeah, there's a lot of ways to think about that. I think if you're a long-only portfolio manager trying to beat the S&P 500, you really have to keep close to market weight the Mag 7. You don't really know something about those stocks that nobody else knows. They're kind of macro. I mean, you know this. If the market's up, growth beats value, large beats small, Microsoft's probably up, right? Like it's hard for you to know something. So I think risk management wise in that setting, you probably keep as close to market weight you can. I'll take the question a different angle though. For me to be bullish on small caps outperforming in an up tape, I have to believe their margins are going up more. So for me to believe that, I have to believe the economy is accelerating. And so I think it's a little hard to believe that at this point. We just talked about the consumer eroding and we need some maybe stimulus, and there was a little bit of panic earlier in the week. People were on TV saying we need 75 basis points. I mean, there was definitely like kernels of truth that were exaggerated, but I don't think it's eroding. I don't think it's imploding. So I think about it as, and I don't believe small caps can outperform.
Employment costs softening. And borrowing costs lower. Those are two potential areas where you can get what you're describing.
That's right. So I think you need. That's right. I think you need to believe the cost of capital. I think that's the biggest one. You saw last November when they first started outperforming. It's because the cost of capital came down. But I think to get a sustainable thing, I need to sort of believe that cutting 25 or 50 is actually going to stimulate growth and the earnings are going to accelerate. And I still think the numbers have to come down a little bit before I can get excited about it fundamentally. So I know you're a great trader, so you're saying tactically, will they rip when the Fed cuts? Maybe for a week or two, but for the fundamentals to carry through, I think that's going to take a little bit longer.
A lot of head fakes in the past few years on that.
Double breaking putt, or whatever you call it.
Exactly. Adam, Rebecca, thanks so much.
Great to have a great weekend, guys.
Thank you, guys.
Absolutely. All right, coming up, in 2003, Outkast's Hey Ya ruled the airwaves, and the bull market was a lot like what we're seeing today, at least by some lights. We're tackling the technicals and comparing today's market to the early aughts. Stay with us.
Coming up, can AI surge a bull market with some staying power? Plus, go for the gold. We hand out the week's medals and a look ahead to next week's retail roundup when Taking Stock returns.
Insurance.
Welcome back to Taking Stock. Our next guest turned somewhat cautious on the NASDAQ right before the recent setback, which reached a 13% decline from the July peak to this week's low. So which way from here? Let's dive into the charts and read between the lines. Joining us now is Zor Capital's Joe Fahmy right here on set. Joe, great to see you.
Thanks for having me.
So I guess talk about what maybe was making you think that the market was due for a little bit of a pullback earlier in July, and where do we sit now?
As far as bigger picture, we started a bull market in May of 2023, in my view. And bull markets last about 3 to 4 years, and with corrections along the way. So my view is this recent pullback is just a normal correction within an overall trend. Why I believe the bull market started in May of 2023 is historically what has fueled bull markets has been innovations and inventions that have revolutionized our lives. Going back throughout history, railroads, airlines, television, PCs, you get the point, smartphones, anything. So what do all of those inventions have in common is they increase productivity. And the new invention or innovation that's going to increase productivity is artificial intelligence. And I believe that's what's going to fuel and continue to fuel this bull market. And proof of that is right when bull markets start, the true growth leaders show up right away. And what happened in May of 2023, NVIDIA had one of the greatest quarters in the history of the market. So I think that's going to continue to be the theme over the next couple of years.
So you say May of 2023 as opposed to October of 2022 when you actually had the price low for the S&P 500?
Correct. It's debatable.
Semantics,
it's up to.
We had this debate. Bull markets don't start at the low. We don't.
That's fair.
There's a price low, but then the stocks sort of take time to consolidate and bottom before they actually launch into a nice sustained uptrend. Yeah.
Joe, one of the things I love about your work is that you are looking at stocks themselves more so than you're looking at economic data, index level performance. And when you screen through, I'm guessing, hundreds of stocks, you're looking at growth stocks and how they are individually behaving to get your feel for whether or not the market is rewarding people for taking new positions, increasing size. So we know what you saw in July. What are you seeing now?
What I'm seeing now is that it's just a normal consolidation. It's August, September, two traditionally weaker months. And there's still so many uncertainties, but I don't see any really sustained downside or sustained upside. Maybe just a range for a while. We've seen volatility back and forth while stocks carve out new bases. And to your point about the stocks is that, Jesse Livermore, who lived over 100 years ago, used to say, so go the leaders, so goes the market. That's why I pay attention to those leading stocks in different growth sectors, because that's going to give me a feel for what the market's going to do.
Before we get to the leaders specifically, we did indicate, we sort of previewed your sense that we're following a similar track from the early 2000s in the NASDAQ. What would that suggest about where we are in the game?
So the chart behind me is there's incredible. I'm a historian. I'm kind of a market geek. So there's an incredible similarity to 20 years ago to the bull market that I believe started around April, May of 03 versus this one. And the four similarities are: number one is we had a prior bear market. So 2002 was the prior bear market, 2022. That's step number one. Step number two is we bottomed. The actual price low was in October 10th of 2002, and as they say, history tends to, rhyme. Literally 20 years to the day, October 13 of 2022. 20 years later, the market bottomed. That was step number two. To the point about after you bottom, you got to form bases. Let stocks form technical bases and consolidate before they launch. That happened as well. That was step number three. And in 2003, we started to move out in April, May of 2003. And fast forward, it's 2023. Now, the big to be determined is that bull market went on from 03 to October of 07 with normal pullbacks along the way. So far, that's what I think is happening and will continue to happen. But we reserve the right to be open-minded and flexible with our approach.
Two areas of obvious leadership right now. One is anything to do with defense. And obviously, we know what's in the headlines. But if you look at Lockheed, if you look at the names that are comprising that sector of the market, those stocks are on fire. But the other area is real estate. 83% of the XLRE components are above their 200-day. This has been above 80% for 22 straight trading days. You really don't see it that often in this group of stocks. Over the last month, real estate sector up 4.5%, the best sector of the 11 S&P categories. When you look at a space like that, and you're in this situation where you want growth, you want leadership to hold up, can you find stocks that fit the bill while we're in this kind of consolidation phase that are giving you a little bit of an edge today?
Yeah, you can within those sectors and look through them. As we know, the market's a discounting mechanism. So real estate, home builders have been acting better, discounting that 6 to 9 months from now rates will be lower. But I don't like to chase sector rotation. I'm a growth manager. I try to stick with what works over time. I'm not going to just try to jump in and out. So I'm trying to stick with some of the growth themes, whether it's semi, software, medical products, some biotech, some pharma, that are, at least in my view, have good growth now and great sustainable growth going forward.
All right. We'll see what that means for NVIDIA and semis and all the rest. Joe, great to have you. Thanks so much.
Thanks for having me.
Thanks, Joe.
Appreciate it.
All right, still ahead, shares of Eli Lilly soaring nearly 11% this week after hiking its full-year outlook on both the top and the bottom line. We're handing out this week's medals and letting you know where Lilly is standing on the podium. Welcome back. As the Olympics draw to a close, we thought we'd get in on the action. So who makes the podium in today's market and who is missing out on a medal? Let's start with the gold. Josh, who do you think deserves the honor this week?
Well, we're saying it's Axon, and this is a stock that is up.
Wait. We were supposed to say Jay Powell. Oh. Axon might get a gold medal in its event as well.
Oh, fair enough. I do actually think that Jay Powell deserves a gold medal.
Yeah.
You're right. And I think the reason why is because he went from Monday looking like he was too late. Then we got this initial claims number, kind of bailed him out a little bit. Maybe he still knows what he's doing.
Yep.
But at least, at the very least, he gets a little bit of a vacation coming up later in August.
He was like down 17 in the second half, like U.S. men's basketball, but then he won.
They almost were pulling him out of the game, and now I think he'll stay in the game a little bit longer.
Gotcha. Silver, we're decided it was Eli Lilly. I mean, and this is not a new story, but it got reinforced.
Yeah, you know what? This thing just has legs and legs and legs. You keep waiting for that quarter or that announcement that there's some sort of a slowdown or competition is caught up, and it keeps not happening. This has got to be a very frustrating name to be underweight if you're in the healthcare space, because on some days it's the only green on the screen.
I was saying today, it's like a huge percentage of the momentum ETF or the S&P 500. It's just vastly bigger now than anything else in its area. Department of Justice for the bronze.
This is the biggest antitrust victory that the United States government
Against
has
Alphabet,
had. Yeah. Really, you have to go back to Microsoft. And what's interesting about this one is there'll probably be some suggested remedies. Again, they don't want Alphabet buying up all of the exclusivity so that every time you get a new device, whether it's Apple or it's Android, they don't want you defaulting to Google and Google making payments for that.
Right.
I would say it's bronze, though, because there ain't going to be any resolution here for years to come. But it's I guess it's
and there's a big question as to exactly how much it would pinch their business, longer term anyway, for that matter. It could save them spending billions to Apple. But you proposed to kick out of the Olympic Village Warner Brothers Discovery CEO David Zaslav. Yeah,
look, this summer made it very clear that if there were some strategic mastermind thing going on at this company, it's still eluding us. This is a guy who basically talked himself out of the good graces of the NBA with a little bit of bluster, backfired on him, and then, of course, a massive impairment charge for the television networks, which we found out about this week. It's one of the biggest drops ever for a stock that I feel like has been dropping since it was born.
No doubt about it. Now, arguably, there isn't a decent strategy to be had for that set of assets, but we'll have to, see how it plays. All right, as we wrap up this volatile week, what does next week have in store for the markets? We'll take a look when we come back. Welcome back. Josh, let's look ahead to next week. Actually, kind of a busy one, starting with the July retail sales number going to be released on Thursday. This market craves reassurance about the consumer here.
It really does, and I've now lost track. I forgot. Are we rooting for good? Are we rooting for good
I think
retail
we're rooting
sales?
for good
or
at this point.
We still are?
Yeah.
Okay. If we're still rooting for good retail sales, I think one of the most important thing that we want to see is whether or not the softness that we're undeniably seeing in the lower-end consumer is starting to tick up into that middle-income consumer. This is really going to be critical. A lot of second-half earnings are predicated on the consumer story not falling apart.
Citi had a report today looking at credit card transaction data for luxury brands that really showed weakness in July. So clearly it's an overhang, psychological and otherwise, on this market. So we also get a bunch of key earnings reports from retail companies on tap in the month. You got Home Depot, Walmart going to kick things off for the sector.
This is actually my favorite week of earnings. I enjoy these reports much more so than I do Tech Week, which was a couple of weeks ago. And the reason why is these CEOs give you a ton of color about what they're seeing on the ground. And from my perspective, they are much closer to and more in touch with the true situation of the consumer. Now, here's the problem. The week ends, and you ask yourself, well, what did we just learn? The answer is nothing, because half are great, half are lousy. This always feels a little bit muddled to me, but I think you can take signal from the better operators.
Walmart is taking share because they're a good operator and their
Target
value
is giving up share. Right.
But Home Depot also should be actually pretty interesting. All right, last but not least, talk about inflation. We're getting the CPI data as well as the producer price index. So PPI Tuesday, CPI on Wednesday. It would seem as if we want to declare victory on inflation, but we're going to get these numbers nonetheless.
The June numbers, which we got in July, sparked a rally. And we're now in a situation where 0.24% on headline, if we can do that or lower, I think it's really meaningful.
It's absolutely meaningful. I do think the market reaction to it will be fascinating. If you get a slightly warm CPI number and the market says, we don't care, we're past it, we know the next move is down, that'll be interesting. If it doesn't, that means maybe we have a little more fragility in the system here, and traders are not yet confident that
we're going to find out together.
Has passed. So. We are going to find out together. Josh, thanks for spending the hours. Awesome.
Thank you, Mike.
I appreciate it. All right, that's going to do it for Taking Stock. American Greed starts right now.